If you're putting less than 20% down on a home, and most first-time buyers are, you are paying mortgage insurance. This is a completely separate cost from your homeowner's insurance. And depending on which loan type you choose, it could cost you anywhere from $73 a month to over $300. In some cases, it lasts for 11 years. In other cases, it never goes away unless you refinance the entire loan. Today, I'm breaking down FHA MIP versus conventional PMI, the upfront cost, the monthly cost, how long you have to keep it, and the credit score factor that changes everything. By the end of this video, you will know exactly which one is right for your situation, and it might not be the one you think. Let's go. First, let's clear up the single biggest source of confusion I see among home buyers. Mortgage insurance and homeowners insurance are not the same thing. They are completely different costs that protect different parties. Homeowners insurance protects you. It covers your house, your belongings, and your liability if someone gets hurt on your property. If a storm damages your roof, homeowners insurance pays to fix it. Mortgage insurance protects your lender. It does not protect you at all. If you stop making payments and default on your loan, mortgage insurance reimburses the lender for their losses. You pay for it, but you get no benefit from it. Why does it exist? Because when you put less than 20% down, the lender is taking on more risk. You have less skin in the game. Mortgage insurance is the lender's way of protecting themselves on a riskier loan. Homeowners insurance goes into your escrow account, and mortgage insurance, whether it's FHA MIP or conventional PMI, also gets added to your monthly payment. That means if you're putting less than 20% down, you are carrying 2 insurance costs every single month. Most buyers budget for homeowners insurance, but completely forget about mortgage insurance. And that oversight can add $100 to $300 to your monthly payment that you were not expecting. Now, let's look at how each type of insurance works. If you're using an FHA loan, which is the most common loan for first-time homebuyers because it only requires the 3.5% down payment. Your mortgage insurance is called MIP, Mortgage Insurance Premium. FHA MIP actually charges 2 separate costs. First, the upfront premium. This is a one-time fee of 1.75% of your loan amount. On a $400,000 loan amount, this is $7,000. But here's the thing. Most buyers do not have to pay this out of pocket at closing. Instead, it gets financed into the loan. It increases your loan balance, which slightly increases your monthly payment. But you do not have to bring that cash to the closing table. Second, the annual premium. This is the one that shows up in your monthly payment. For most 30-year FHA loans with 3.5% down, the annual premium is 0.55% of the loan amount per year. If you put down at least 5%, it drops slightly to 0.50%. On a $400,000 loan at 0.55%, that's $2,200 per year, which breaks down to about $183 per month every month, for as long as the premium is in effect. Now, how long does it last? That is an important part that you must understand. So if you put less than 10% down on an FHA loan, which is what most FHA buyers do because the minimum is 3.5%, the MIP, the mortgage insurance premium, lasts for the life of the loan. It never goes away. Not in 5 years, not in 10 years, not in 20 years. It stays on your loan until you pay the loan off, sell the house, or refinance it into a different loan type. If you put 10% or more down, the MIP, the mortgage insurance premium, actually drops off after 11 years. There is one thing about FHA MIP that is actually a major advantage though. And it's in the reason FHA loans are often the best choice for certain buyers. FHA mortgage insurance is not based on your credit score. The premium is the same whether your credit score is 580 or 780, 0.55% either way. The upfront premium is 1.75%, either way. This is fundamentally different from conventional PMI, where your credit score is one of the biggest factors in determining your rate. And it's why, for buyers who are still building their credit, an FHA loan is often the smarter financial choice. One piece of good news. In March 2023, HUD cut the annual MIP by 30 basis points, and that lower rate is still in effect today. That cut saved the average FHA borrower about $600 per year. Now, let's look at the other option. If you're using a conventional loan, which is a loan that is not backed by the government, and you are putting less than 20% down, you will pay PMI, private mortgage insurance. Conventional PMI works differently from FHA MIP in several important ways. Here's the deal. I make free videos for you. I actually know what I'm talking about. And if you implement, it will help you and or your family get onto the property ladder. The only thing I ask is that you hit that subscribe button and the notification bell. Number one, there is no upfront premium, no 1.75% fee, nothing financed into your loan. You just pay the monthly cost. That's it. Number two, the annual rate. Conventional PMI typically runs between 0.22% and 1.0% of the loan per year. That is a wide range, and where you fall in that range depends on two factors: your credit score and your loan to value. A borrower with a 760 credit score putting 15% down might pay 0.22%, which on a $400,000 loan is only about $73 per month. A borrower with a 670 credit score putting down 5% might pay 1.0%, which is about $300 per month on the same loan. Number three, how long you have to keep the PMI. By federal law, under the Homeowners Protection Act, conventional private mortgage insurance must automatically be canceled when your loan balance reaches 78% of the original home value. You do not have to ask. You do not have to refinance. The lender is required by law to remove it. You can also request removal earlier at 80% of the loan to value if you get an appraisal showing your home has increased in value enough to reach that threshold. So which one should you choose? Let me give you a decision framework. If your credit score is below 700, FHA MIP is often the better choice. And here's why. FHA MIP is the same rate regardless of your credit score. 0.55% whether you are at a 580 or a 680. But conventional PMI gets more expensive as your credit score drops. Below 700, conventional PMI can easily exceed what you would pay with FHA MIP. If your credit score is still a work in progress, FHA usually gives you a lower monthly mortgage insurance cost. If your credit score is above 700, conventional PMI is usually cheaper. Your stronger credit score drives PMI rates down. You might pay 0.3 or 0.4% instead of FHA's 0.55%. And the PMI goes away automatically when you reach 78% of the original loan to value. No refinance required. If you're planning to stay in the home long term with less than 10% down, conventional PMI is likely the better long-term play because FHA MIP stays on for the life of the loan, while conventional PMI cancels automatically over 10 or 15 years. That difference adds up to tens of thousands of dollars. If you're planning to refinance within 3 to 5 years, either option can work. FHA might have a lower monthly cost initially, and you can refinance to a conventional loan once you build up enough equity to drop the MIP. This is called the refinance exit strategy, and it is what many FHA buyers do. The single biggest question to ask yourself is this: will I have 20% equity in the home within 5 to 7 years? If the answer is yes, Through a combination of you paying down the principal on the home and home appreciation, conventional PMI is likely cheaper over the life of the loan because it goes away on its own. If the answer is no, or you are not sure, FHA gives you certainty. The rate is fixed. It does not change with your credit score, but you will be paying it for as long as you have the loan unless you refinance. Your credit score is the single biggest factor in choosing between these two loan types. Not your down payment, not your interest rate, your credit score. If your credit score is above 740, you will almost always come out ahead with conventional private mortgage insurance. If your score is below 680, FHA is usually the better deal. Between 680 and 740, it depends on your specific situation, and you should ask your lender to run both scenarios side by side. Either way, FHA or conventional, if you are putting less than 20% down, you are carrying 2 insurance costs every month until you build enough equity. Homeowner insurance and mortgage insurance. Budget for both. Do not let either one of them surprise you. So now, you know what your real payment is from video 1. You understand mortgage insurance from this video. The final piece is knowing what to check before you make an offer on a house. In the next video, I'll give you my 8-point buyer checklist. These are the 8 things I check on every single property. From insurance quotes to roof age to flood zones to deductible structures. Missing any one of these can cost you hundreds a month or kill your deal at closing. Click the video on the screen to watch it right now. Until the next time, let's be good to one another. Let us let grace abound. But most importantly, you guys stay blessed. Indeed.